My name is Jake, welcome to the channel. In today's video, I want to talk about the best international dividend growth ETFs out there. So it's not going to be a video where I just share my opinion. I'm going to go through, I'm going to break down and benchmark the different ETFs out there and kind of share with you, some things that you can look out for, some things that I would look out for. We're going to compare things like expense ratio, the fund methodology. So what is the underlying index? We're going to talk about the dividend growth rate, the number of holdings. So the majority of the video will be focused on really just benchmarking the different criteria, and towards the end I will share my opinion and some of the thoughts that I have, because all 7 of these ETFs, I'll be very upfront, I don't own in my portfolio today. There is actually 1 or 2 that I'm considering adding, but it probably wouldn't be in my taxable account. It'd be in my tax sheltered account. So I'll talk more about that towards the end of the video. Now, if you follow my channel, as I just mentioned, I don't invest into international dividend ETFs in my taxable account. I do own an international ETF, but it's not focused on dividends. It's focused on the total return. That ETF is VXUS. I own that in my Roth IRA, but we're not going to talk about that ETF. I really want to focus on dividend focused ETFs. But before we dive into that, I want to share a few things here really quick. And a lot of this will make sense in a moment. So stick with me here. So in my cash flow portfolio here in M1 Finance, this portfolio is intended to pay for my living expenses in the next 2 years. In 2 years, my wife and I, we're going to quit our jobs and we're going to live off of the dividend income from this portfolio. This portfolio, it's kind of depressing seeing all the red. If I go here to the last week, it makes me feel a lot better. It's really, really green. But anyways, let's show the real values here. So I invest into ETFs like SCHD, VYM, DGRO. You know what the cool thing is, and we'll talk about this in a second, each one of these, there's an international equivalent. Okay, and we're going to talk about that in this video. But I also invest into cover call ETFs. I'm not going to be adding any additional money to these ETFs, but the thing that I want to focus on here with this, why I'm showing you this, is I only have a small percentage directly allocated to international. That's with British American Tobacco and with Philip Morris International, 2 tobacco companies. So I'm not advocating for these companies. I'm just showing you that these are international based companies, or that are focused internationally. But the thing that I want to share with you is, 2 things. All right. First, you look at these companies in here, some of them that stick out, for example, McDonald's and Coca-Cola. Now, I want you to think for just a second before I show you, think about it for a second. What percentage do you think they generate their revenue internationally compared to the US? So think about it for just a second. Think about Coca-Cola. Have you ever went on vacation to Europe? Have you ever traveled? What percentage of the revenue that Coca-Cola generates, how much of it is in the US? Same thing for McDonald's. And how much is international? Well, let's take a look. For example, here on the annual report here for 2021 for McDonald's, if we scroll down here, we can actually see, if I can find this here, let me go to page, I was just looking at it a second ago. Let's see if I can find it here quick. Slide number 18 right here. Let me zoom into this. You see this in 2021, 41% of the operating income for McDonald's was generated in the US. That means more than half was generated international. And so the actual revenue, not the operating income, the actual revenue is actually higher than 41%, but the actual operating income, less than half, is in the US. And by investing into McDonald's, I get instant international exposure. So you don't necessarily have to go out and just specifically look for an international company, because if you're investing in the S&P 500 or these large blue chip companies here in the US, you're going to get instant diversification internationally through these large companies. Now let's take a look at the other one here with Coca-Cola. Maybe I can zoom in here. Here in 2021, the operating segment here for, the revenue distribution, is 34% for Coca-Cola. A third of Coca-Cola's revenue is generated here in North America. Isn't that incredible? Coca-Cola and McDonald's, they're international companies. Now, you might be thinking to yourself, well, what is Jake trying to say? Is he advocating for or against international companies? What am I saying here? Well, there could be a reason why you would want international exposure and reasons why you wouldn't, okay? But let me give you the other side of this of maybe why you would want to consider international ETFs or international companies. So let's take a look at VYM for a second. This is a high dividend ETF here in the US. What I want to look at is, of all the holdings in this ETF, the 444, what is the underlying price to earning ratio for this index here? And let's see if I can find it. It's right here. Price to earnings ratio, 13.5 is the PE ratio. So still less than 15, but still pretty high. Now let's take a look at the equivalent of VYM, but the international version with international stocks. International, there's just over 1,300. I think there's just under 1,400 actually. But let's look at the price to earning ratio. It's under 9. Under 9. So a good reason to invest in international stocks is you're not paying a premium for these companies. Okay, so if you're a value investor, you may actually see a lot more value at the current prices with international stocks. Okay, so those are two, examples. An example, against going and focusing strictly on international, and an example for it. Okay, so that's hopefully setting the stage when you're thinking about your own personal strategy. Do I want to invest in international? Do I not want to invest in international? I think it really comes down to you, okay? And it really depends on you. And I don't really truly believe that there is a one size fits all when it comes to this. I just showed you two examples here of what, one example of for it and one example maybe against it, okay? And you have to make the decision for you. All right, so the remainder of the video, we're going to focus on 5 things. We're going to take a look at these 7 different ETFs. We're going to look at the fund facts, the expense ratio, the diversification. We're going to look at the dividend metrics, the yield, the dividend CAGR. We're going to look at the fund methodology. We're going to also go into Seeking Alpha, and we're going to take a look at the total return comparison. If you've been following my channel, you've heard me talk about total returns a lot. It's because it's very, very important. And then lastly, I'm going to touch a little bit on taxes and some things to consider if you're holding this in a taxable account, some things that you definitely want to be aware of. I think most investors, especially those here in the United States, we know that it's important to, broadly diversify. We know that there's more to, just the United States. There's other great companies out there. But I think, having grown up in the US, it's kind of hard to not admit that in the US, we are kind of, bubbled. We do live in this little bubble and we're kind of ignorant to, what happens outside of the United States. And, it kind of looks a little like this.
Can you name 3 countries besides the USA?
I suck at history. I was like my worst subject. Can we do like science?
No. Any three, you know this.
A country? Oh my jeez, this is terrible. Oh my god. A country. Wait, besides the US?
Yeah.
I'm sorry, I can't.
All right, it's fine.
I can't do history, I can't.
You're so bad at lying, it's not even
funny. Go. Come on, do it.
You guys say Colorado.
Oh my gosh. All right, so let's take a look at the first one here, VYMI. This is from Vanguard. Let's take a look at a couple of things here. So I'm going to do this with the first one, and then the other 6, we're going to kind of breeze through them, and I have an Excel sheet, and we'll benchmark them and compare them on one view, okay? So if you want to do this for the others, you can watch how I do this here on Seeking Alpha, and then you can do it yourself with the others if you're interested in checking out the others in more detail. But what I like to do is I first want to understand a few of the facts, right? So what are the assets under management? What is the expense ratio? When is the inception date? So how long has this ETF been around? The reason why the inception date is so important is then you can benchmark it against under other indexes, for example the S&P 500 and such. So that is important. If I were to narrow it down, when you're looking at indexes, the most important thing that I look at, the first thing is the expense ratio. How much are they going to charge me? So, and then the second thing that I'm looking for after the expense ratio is I'm looking at the fund profile. So this is the fund methodology. So every ETF follows an index. And so you have to understand that there's thousands of indexes, and the ETF will perform based off of the performance of the underlying index. Okay, let me repeat that. Every ETF follows an index, and the index is passive. And whatever the methodology of that index is, that will be the performance of the ETF. Okay, subtracting the fees, the fund fees, et cetera, okay, and taxes and all that stuff. The fund methodology for VYM, it follows the FTSE, so Financial Times Stock Exchange, All World, X meaning excluding, US High Dividend Yield Index. I know that's a mouthful, but that's this index that is being tracked by VYMI, okay? And so VYM, the US version, is essentially the same thing, FTSE, that index for high dividend yield, but for the US, okay? So you're getting the internet, just the exact same thing as VYM, but international. Okay. And so they also have benchmarks that look at, dividend yield, dividend growth, payout ratios, and such. So they do have those metrics. In fact, you can go over to the VYMI or, the Vanguard site here, and you can actually read the fund description. And because this is so important, once again, the number one important thing when you're looking at an index or an ETF, one, look at the expense ratio, and then two, look at the methodology, the fund methodology. Okay, let me read this because it's so important, right? When a lot of times, new investors will ask, well, hey, is this a good ETF? Or, hey, what do you think about that? Well, you have to understand the index, because the index is going to determine what, over time, what the fund is going to do. Okay, so let me read this really quick. So the Vanguard International High Dividend ETF seeks to track the performance of the FTSE All World ex-US High Dividend Index, which focuses on companies located in developed and emerging markets, excluding the United States, that are forecasted to have above average dividend yields. The fund invests by sampling the index, meaning that it holds a broadly diversified collection of securities that, in the aggregate, approximates the full index in terms of key characteristics. These key characteristics include industry weightings and market capitalization, as well as return financial measures such as price to earnings ratio, dividend yield, etc. Okay, so it's market cap weighted, which is important. The experience and stability of Vanguard's equity index group have permitted continuous refinement of techniques for reducing tracking error. So this is meaning that the fund managers at Vanguard are tracking this index, right? And then the group uses proprietary software to implement trading decisions that accommodate cash flow and maintain close correlation with index characteristics. Vanguard's refined indexing process, combined with low management fees and efficient trading, has provided tight tracking net of expenses. Okay, so the goal here, the big piece to understand here is it's market cap weighted, it's focused on high dividend yield. The fund managers at Vanguard, which this is a passive index, it's a passive fund, they look to track this index. So whatever the performance of this index, that will be the performance of VYMI. Okay? And this same process is the exact same for all of the other 6 ETFs that we're going to review here. Okay? I'm not going to go into this much detail with the others, but this is the benchmark. This is how you compare the different fund methodologies of these ETFs, and all ETFs for that matter, okay, whether it's US or international. All right, let's go back to Seeking Alpha and let's take a look at some of the holdings in VYMI. So first off, you are getting high exposure to financials and energy when you're investing into VYMI. Now, this is how it's set up. This is how the index is set up. So the companies in this index follow this breakup of the holdings in this index. The top holdings are, for example, Roche Holdings, AG, Shell, Toyota, Novartis, and so forth. A lot of these companies I personally am not familiar with. Some of them I am. Okay, and you can see the total weighting of these holdings is just under 15%. This is a highly diversified ETF, which I personally really like, as a large number of holdings. And in my opinion, international, I like having a larger number of holdings. For me, I see that as less risk. I personally really like that. Okay, a couple of things that I also want to look at is the 5-year dividend growth rate. This is how quickly the fund is growing its dividend. So over the last 5 years compounded, it's grown at an average of 10% year over year over the last 5 years. So on average, which is really, really great. Pays a dividend quarterly, and the current dividend yield is just over 5%. So this is pretty high. You know how we saw earlier how the price to earnings ratio was lower with VYMI? It's because it's not trading at a premium like VYM and other US indexes. Okay, and this is something cool. You can check out this. I'm not going to do this with all of them, but if you do have Seeking Alpha Premium, what you can do is, you can look at other things like the quant rating. You can see that up here. You can look at the ratings here, the ETF grades, the risk, the dividend grades. Something that I also like to look at is the subclass. So the class here with foreign large value ETFs. If you want to do additional research and you're a nerd like I am, you can check out and you can see what other indexes or ETFs are similar to the one that you're looking at. So yeah, I believe that this is free with the free version. I'm not 100% sure. When it comes to the other features like the quant ratings and the grades, you will definitely need Seeking Alpha Premium for that. If you want to sign up to Seeking Alpha Premium, I will leave a link in the description below. You'll get 58% off. So instead of $240 a year, it'll cost you $99. So it's 58% off. So if you want to check that out, there's a link in the description below. Some of the features that we're going to be viewing here in this video are going to be available with the free version. Some are only going to be available with the premium version. All right, now let's quickly take a look at another one here. So let's look at the DWX International Dividend ETF. Let's scroll down here and just briefly look through this. This is the Spider Index one here from State Street. You can see the index that this is following and the fund profile. I would encourage you to, if you're interested in this ETF, to take a look at it. You'll have the assets under management here. This is how popular the ETF is. The expense ratio, this one has a higher expense ratio, the inception date, and all that good important stuff, as well as the dividend yields, the dividend growth, the number of holdings, and so forth in the utility breakup. And so, yeah, you can check out this one. And once again, here, I'm going to go and I'm going to compare these all side by side. Another one here that we'll take a look at is VIGI. This is from Vanguard. This is the international version of VIG, the Dividend Appreciation ETF from Vanguard. You can see the expense ratio, the assets under management, inception date. You can see here that this one is focused heavier in healthcare and consumer defensive. So this is going to be a bit more growth oriented. Now, and you can see here the total weighting. This is like night and day with VYMI. Okay, and then the dividend growth. Now, this is something that I will touch on in a second. This dividend growth, take this with a grain of salt. They had a massive payout last year that was not consistent with their previous year, so I would not consider this a source of truth going forward. Okay, another one here is IGRO. This is the iShares International Dividend Growth ETF. This is really cool. I'm interested in this one because this is the international version of DGRO. If you follow my channel, you know that I invest into the US version of this ETF. And if I'm not mistaken, the fund is Morningstar. The index, yep, look at that. I know my stuff. The fund methodology here is tracking the Morningstar Global ex-US Dividend Growth Index. So essentially, it's the exact same thing as DGRO, but international. Okay, so a couple of things. The expense ratio is pretty low. Assets under management is not bad. You can see here it's focused more on financials, also healthcare. And then you go down here, you see they got over 400 holdings. I actually personally really like this. In my opinion, 400 with 26.5% in the top 10 weighting. I actually like this. They got Unilever, Roche, Nestle, Novartis, like really like the top holdings here I've heard of, and I personally like. They got Toronto TD Bank in Canada is one of their top 10 holdings. Really, really interesting. The dividend growth rate, this is the only concerning thing, is it has a very low dividend growth rate. Okay, let's take a look at another one here. This is the Schwab International Dividend ETF, SCHY. Now, this is another cool one. If you've ever heard of the ETF SCHD, this is SCHD for international. Okay, it's the exact same fund methodology, except it's focused on international. So you see here the Schwab International Dividend Equity ETF. If I'm not mistaken, this follows the Dow Jones. Right. Yep. Look right there. Dow Jones 100 index. But the thing is, it's representing the international stocks. So it's SCHD's equivalent for international. But the thing is, it's very, very new. It's only been around for about a year, has a low expense ratio, it has just a few assets under management. I am very, very interested in this one. So if I were to invest into one, like I said, I don't invest in any of these. This is definitely on my radar. Okay. I like the consumer breakdown. You got consumer defensive, communication, which is interesting. I'd be curious what they have in there for so high. Financials, etc. Top holdings, Unilever. You probably heard of that. I use their shower gel every day, right? You got the Deutsche Post, Roche, British American Tobacco. I own this company. Interesting. TD Bank, some good ones. It's overall, I think you're not going to get the same dividend CAGR, I believe, like with SCHD, but for international exposure, it's not bad. The only concern thing that I have is as a really high percentage to the top 10. It's very top heavy, which in my opinion, I'm not the biggest fan of personally. So let's take a look at another one, FID. This is from First Trust. I'm not familiar with this one, but what's cool is they have the International Dividend Aristocrats. So this would be the international version of Noble from ProShares. Okay, so let's take a look at this one. The fund methodology here, it's looking at International Dividend Aristocrats. So international companies that have increased their dividend for 25 consecutive years. Okay, it's been around since 2013, has a high expense ratio. So it's almost double of Noble. Noble is 0.35. Does not have a lot of assets under management. Okay, 80 holdings. A lot of these companies, personally, I'm not even familiar with. I don't even know these companies exist. So this is the only concerning thing. If it's a Dividend Aristocrat ETF, how does it have a negative dividend CAGR? That's concerning. So anyways, the last one here is PID from Invesco. This is the Invesco International Dividend Achievers ETF. So not quite 25 years, but a consistent track record of dividend growth. And you can see here the the fund methodology in terms of how they track this index. But yeah, like I said, all the dividend achievers will be in this index. And it's heavy towards utilities, financials, and it is very, very, very top heavy. Only 50 companies. Okay, so something to be aware of. And it also has a fairly low dividend CAGR. Now, before we go and we benchmark these side by side, let's take a look at the total return of these. And so you're able to do that by adding them in here in the comparison section. You can only do this with the premium version. If you don't have premium, you can watch me do it here. So what you have here is you can check it by year to date, last 3 years, last 5 years, the last 10 years. What you'll notice is not all of them have been around for 10 years. So I'm going to use the 5-year here. And so by the price return, this is just the share price. Okay, so this is not with the dividend reinvested. Without the dividend reinvested, the best one performing is the one from Invesco, PID. The second is VIGI. The worst performing is DWX. Now, SCHY, take this with a grain of salt because it's only been here for a year, right? But let's take a look at the total return. This is with the dividend reinvested. With the dividend reinvested, it shows a little bit of a different story. You can see here that the Invesco one is performing the best over the last 5 years and followed with VIGI. And the worst one here, let's take out SCHY for this sake, but you can see here it's minus 10. Let's add the other one here in FID. Let's add this one. We can get a better understanding here. So with FID, Yeah, the total return is negative. So it's actually the worst performing one. All right, so the winner of the bunch here when it comes to the total return is the Invesco PID, and then followed with VIGI, and then the IGRO. Okay, interesting. All right, one last thing before we go in and we benchmark them side by side here in Excel is you have to understand how dividend ETFs or dividend stocks in general are taxed. You have to understand that each country has a different relationship with the United States. So for example, if you invest into companies in the UK, you're not going to pay international tax. However, if you invest into REITs in UK, it's a little bit different, right? So you're not going to get qualified. You're going to get non-qualified. Now, I will leave a link to a video that I made on international tax. This is one of the first videos I made on my channel. I go into detail and I actually show which country requires what percentage in an international tax. So not only are you paying the US tax, either qualified or non-qualified, but you're also paying an international tax on top of that. Okay, so something to be aware of. But here for VYMI, for example, there's an article here on Seeking Alpha that was pretty good that I thought would just make it easy to highlight here. So with VYMI, the dividend that was qualified here in 2019 was 71%. So this is actually pretty good. So 71% of the dividend constituted as a qualified dividend. So that would be like a Coca-Cola or a McDonald's. That means 29% is a non-qualified. So you're going to be paying ordinary tax rates for the remaining 29%. The other thing here is the foreign tax. So this is actually not bad at all. Just under 7.5% in 2019 was there was an international tax of over 7%. That's actually not bad. 7% is actually very low. Now it doesn't show what 2020 and 2021 is, but you know, I would just, you'd have to do your own research. I don't have it in front of me right here, but it's less than 10% these last couple of years. This is actually a very tax efficient international ETF. Okay, and so once again, if you're not familiar with the taxes here, go and watch that other video, or do a quick Google search and understand that you're paying not only qualified or non-qualified taxes in the US, but also a foreign international tax, depending on the country of the headquarters of the company that you're invested in. Okay, and with the ETFs, it's a blended mixture based off of the underlying holdings in the index. All right, lastly, let's take a look and let's benchmark all of these together and let's see, each category and let's rank them, worst and best. Okay, so the first one here, we got VYMI, we got DWX, VIGI, IGRO, SCHY, FID, and PID. And you can see the fund methodology for each. You can see here, we looked at VYMI in detail. You can see that the spider one here is the S&P International Dividend Opportunities Index, the Vanguard Global Ex-US Dividend Growers Index, the Morningstar, so this is the equivalent of DGRO, this is the equivalent of SCHD, and then you got the Dividend Aristocrats and the Dividend Achievers. Now let's take a look at the first one here with the expense ratio. The expense ratio of the bunch here, it looks like the SCHY is the winner of the bunch and the loser is the First Trust dividend ETF. In terms of the inception date, take this with a grain of salt. It's not necessarily a make it or break it kind of thing, but the winner here is Invesco, and the loser, if you want to call it such, just because it's newer, would be the Schwab, SCHY. Assets under management, the winner here is going to be VYMI, and then the loser here is going to be the FID from First Trust. The number of holdings, now once again, I personally like having more holdings. More diversification is better in my opinion when it comes to these, especially international. VYMI is the winner here with the most, and then the loser would be the Invesco PID. Now, the top 10 weighted holdings in here, I personally like to have this percentage lower because it reduces risk. The winner here is going to be VYMI at 15%, and then the loser here is going to be the Schwab SCHY with 39%. And then the country diversification, so what I did here is I added up the top 5 countries by percentage, and then the highest percentage, in my opinion, is worse. the lower percentage is better because that means you get more international diversification. Now, take this with a grain of salt. It could be a little bit arbitrary. Some countries are more developed than others, and it just take this with a grain of salt. But for the sake of it here, the winner here is going to be VYMI with 50%, and the loser is going to be Invesco PID at 87%. And so the 4-year dividend yield, this is not the current yield. This is the average of over the last 4 years. I went and I manually added up the last 4 years, the average dividend yield, and I averaged it out over the last 4 years. This is what you could reasonably assume if you're dollar cost averaging into this index. This is the dividend yield, the starting dividend yield that you could assume. It's not guaranteed, but let's humor me here, okay? The winner here, the higher the better, obviously, in my opinion. Now, it's all depends on your time horizon, but the winner here with the highest is going to be DWX. Excuse me, no, actually it's FID, the First Trust one, just slightly higher here. And then the worst one here, I guess it depends, right? I keep saying worse and best. It really depends on you and your time horizon. But VIGI comes in at the lowest at 1.65%. The dividend CAGR. So the winner here is VYMI at 10%, and the loser here is DWX at negative 4.82%. So the VIGI is actually, if you go and you look at the other years without the 2021, like that massive spike that they have, it averaged right around 1 to 3%. So I would not factor in a 53% dividend CAGR going forward. Okay. And I didn't dig into it. I can't say what happened. Like, did they sell something? Did it get issued as capital gains? Like, I don't know. When looking at it at face value here at the surface, you'd have to dig in and see what that is. Anyways, in terms of the total return, the highest performer, the winner here is going to be from Invesco PID at 28%. And then the negative here is going to be from First Trust FID with a negative 2.4%. So if we visualize this and the best and the worst here, you can see clearly based off of the metrics here, as I've explained them, VYMI is going to be the best here, or the best performing in terms of the category or the criteria that we're looking at here. In terms of the worst, it really is kind of a mix-up between PID and FID. The only thing so the thing that's interesting is the Invesco one has the highest performance, but it has a really high expense ratio. It has really low country diversification. So take that for what you will. It only has a small number of holdings. So I think it's kind of a mix up. But if I had to choose the worst one here, I would choose FID from First Trust because of the total return over the last 5 years. You've had a negative return. And so that's why for me, the First Trust one ranks the worst. The best one, in my opinion, for consistency, I like VYMI. So let me just end here with saying a couple of words when it comes to this, what's on my mind. So my opinion when I look at this. So currently in my my taxable account, so in M1 Finance, I do not plan on adding any international ETFs to my portfolio. My plan is in my retirement accounts in my Roth IRA. I have a large exposure to the total stock market and growth ETFs. My plan is over the next 25 years to compound and to reinvest the dividends in those growth ETFs in my Roth IRA. And then once I reach the age of 59 and a half, reevaluate where I'm at. But I could definitely see myself choosing one of the ETFs here or a handful of the ETFs here and then investing into these into my tax sheltered account in the future. So then what that would look like is I would sell out of the growth stocks in my Roth IRA in 25 years, and then I would invest, for example, in VYMI as an example, right? But I don't intend to invest into these now for the next 25 years. At least I don't have any plans currently. Things could always change, but that's my personal approach. But if you're, for example, you're saying, well, Jake, what you showed me earlier in the video with the lower price to earnings, I'm a value investor, I don't want to overpay. Well, then, yeah, it can make absolute sense to start picking, one of these, or another international dividend ETF or ETF. that that you really like and have conviction in, and investing into that now. There's really nothing wrong with that. But that's my opinion, how I plan to do this. My personal favorites, I really like VYMI. I like the index. I like the expense ratio. I like the issuer, Vanguard. I also really like these two right here. These two as well, because I invest into the US version of these, I could definitely see myself, once I reach, the age of 59 and a half, I could definitely see myself later adding exposure to international. So those are my thoughts and opinions on this. I think it really comes down to you and your personal time horizon, because this is, you have to really look at the whole picture and you have to understand what's right for you. So that's what's on my mind. That's how I'm looking at international dividend ETFs. I hope that this video was helpful. I hope that you learned something new, and I'll catch everybody in next week's video.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.